Welcome back to the fastest growing life insurance podcast. My name is Caleb Williams. We got Dom Rufran. In recent years, Dom, IULs have exploded in popularity. Thousands of new agents are selling it as a promise of higher returns, and it's often promoted as the main product used for infinite banking. But does IUL actually work for infinite banking? In this episode, we're going to be addressing this very question, as well as comparing IUL and whole life policy designed for infinite banking to see which one performs better, and newsflash, maybe which ones that we would rather use when you look at all the facts of the case.
How to become your own bank using an IUL. Let's look. So here we have a 40-year-old male non-tobacco user. He wants to set up his own bank using an IUL. So he's going to put away $25,000 per year for the first 4 years, and then $6,000 a year every year after that, just to kind of maintain it. So that's him building the foundation of his bank. So you'll see by year 5, he would have put in $106,000. Assuming a 6.7% weighted average, he's right there at $105,000, pretty close to $106,000 if he had a better return. So he broke even. He built the foundation of his account. So now every year after that, you can see the next year he puts in $6,000 again at year 6. His account value is projected to go from 105 to 116. So now he's making money every single year he put money in. He's at a positive rate of return. So at year 10, he had a total of 136. He's at 168, and he has full control of this money as if it's in a bank account. He has access to $165,000. He's able to leverage this surrender value column at any time in his life to purchase assets, pay expenses, whatever it is. So if he keeps funding it here, he can still access it here. And when he accesses it here, he's borrowing loans tax-free, so the account's uninterrupted. So he never loses control of his funds, okay? That's what it means to be able to become your own bank. Is you don't lose access or control or utilization of your funds. And he's compounding at a way higher rate of return than a typical bank. If he was putting these funds in a bank account, he's probably maybe getting 1% returns if he's lucky, 2 to 3%, maybe in a HISA. But here he's also protected with the death benefit. So God forbid he ever passed away. Starting on day 1, you can see here, he put in that $25,000. The end of that first year, he's worth about $416,000 if he passed away in that first year. So he always has a positive, a huge, highly positive return if he was to pass away. But again, we don't want him to pass away, but he's going to. So then if he just never, and then I'm even going to show you if he stopped contributing at age 65, because hey, age 65, he stopped working and he didn't want to still put the $6,000 in here for some weird reason, even though it was giving him a positive return. Even if he stopped, you can see here his account value just keeps going up and up and up and up. His death benefit keeps going up and up. He has full control of his funds if he needs to use this account because he didn't have any other retirement accounts. This could have been the retirement account. But if he passes away at age 90, he's projected to leave over $3 million tax-free to his family. And all he ever put into this quote-unquote bank is a $226,000 contribution that he put in that first, 25 years of his planning of this. But really, what really did was this first 5 years. You hear everyone talking about becoming your own bank, using life insurance to do that. If you are interested in becoming your own bank, using life insurance and really understanding the principles and strategies for you to do so, drop a message below. I'll personally reach out. We'll schedule a call. We'll see if this makes sense for you.
You know what we should do sometime? We should literally call these people on the show live and just be like, hey, I want a life insurance. I want to be my own bank. Can you walk me through that? I think if you want us to do that sometime, let us know in the comments. We could probably set something up like that. I don't know if we're known enough in the space if people would find us out, and I have a hard time lying. So it would it's another story, Dom, on a couple of years ago. We'll have to tell a story when I tried to go undercover and it backfired on me. But without further ado, Dom, why don't you give your take on just this video summary? He said a lot of words. He gave me a little bit of mind grade going back and forth. But I think it's a great video to comment on.
Amazing. First and foremost, I think we have to identify what his objective is when he's designing these types of policies. The Nelson Nash himself would say, hey, don't ever use IUL when it comes to the infinite banking concept. Theoretically, he's not calling this infinite banking. He's calling this become your own banker. And so I know that, a lot of times they're utilized, they're interchangeable, they're synonyms in a lot of ways. And the concept, in my opinion, it's going to be the same across the board, right? You take money, you put it in a life insurance policy, you store it, and then you leverage it and use it for something into the future. And so I just want to be very clear within that. Now, it could be that the infinite banking concept is talking about a utilization of dollars like super early, and become your own banker could be talking about using your dollars later on, in theory, right? And I think that's why identifying when you're talking to a human of like, what is your objective? You first and foremost have to identify, will this product be good for your goal? And my personal belief is based off of somebody wanting to utilize a policy for cash value to borrow against other activities that's likely not emergencies or retirement or something along those lines. You probably should not be using an IUL and should specifically be using a whole life for that strategy. So become your own banker, IBC, the and asset, all of those different types of strategies, quote unquote, storage of cash value for utilization should be specifically for whole life. So that's the first thing. Secondarily, I got to give this guy his props and his kudos though. We look at a lot of different illustrations. We look at a lot of different designs, whether it's whole life, whether it's IUL. And this IUL is actually structured extremely well for an IUL policy. And so I think that that is something that you have to give him credit for. And when he's speaking around this product and the strategy in general, he's actually speaking about it extremely well too. And so that's why I really like that we're comparing this video and talking about like IUL versus whole life, is because we're not just taking the worst of the worst designs where there's like no cash value and essentially like, oh, like look how bad this was. We're actually looking at a fairly well, decently designed one and saying, well, should we use this IUL or whole life for the concepts that we're talking about today?
Yeah, we don't do what some of our other friends on the internet do and have the same talking points on whole life. They use like some crappy whole life stock company, and so yes, just know, for all the people that are chirping in the comments, we're trying our best. And I will say that there's a couple things that he does in this video. First of all, the illustration that he shows is pretty solid. I think both you and I would agree. We're like, hey, this is a pretty solid IUL design. I mean, the fact that there's early cash value in year one, that's pretty healthy. Surrender value is pretty impressive. I do think we need to describe the difference between account value and surrender value. In the video, he even switched between, and it seemed like, and again, I'll give him the benefit of the doubt. It seems like he switched when it was most convenient. He talked about, oh, this is your money. And then he talked after year 5 about this is the money that you have access to, kind of deal. And that's one of the things that doesn't really happen in whole life. Your cash value is your cash value. Versus like in IUL, you have almost this account value versus surrender value. Do you want to explain the difference, Dom?
Yeah. So your surrender value is something that you can think of more like your whole life cash value. It's essentially the money that you would actually have access to if you were to borrow against and use it for something. If you were to cancel your policy, that's really what the insurance company would give you for return if you wanted to walk away. The account value is essentially saying, and the account value is always going to be higher early on. After the first 10 to 15 years, depending on the policy, those numbers will be identical. And the reason why that they are different in the first 10 to 15 years is that IULs have surrender charges that are built into them. So that's why the account value is higher. This account value is what your policy is worth. It's what it's getting credited towards. But your surrender value is the actual dollars that you have control and access and liquidity for.
So if you're using to borrow against or withdrawing or surrendering, the surrender value is what matters. The account value is, in a way, it's interesting that insurance can kind of get away with this, but it's a way for them to almost share like almost like a fake ledger. Like, I'm not saying I'm sure they're using it from a calculation about indexes and all, but it's like not really real. And I'm sure we could have a whole nother video about that, but that's the difference. I think you did a great job explaining that. Okay. So let's talk before we look at the illustrations, because I think this is where what really is going to matter is like, let's actually just compare illustration to illustration and show the pros and cons. Let's talk about the pros in the IUL camp first and foremost. So the talking point in the IUL camp would say you have a ton of flexibility. I even saw that it seemed like this, on the illustration, this person on the illustration switched the death benefit to be favorable, like from A to B and all. So it seems like, there's flexibility that you get with an IUL. And then one of the other big talking points is, like, obviously you saw in the illustration, they're assuming 6.7% crediting every single year. So we're assuming that's that's a big assumption. But obviously, long term, anyone that looks at that says this IUL, I don't care how it's designed, long term is going to look better than any whole life. And that's just a guess. I could be wrong. You look at the pure numbers, and that's a guess. So the second talking point is IULs are going to perform better long term because of the upside that they give you. And then, what would the third talking point be is you have flexibility, you have some upside. And Dom, because you came from the IUL space, what are the other like selling points to IUL versus whole life if we're trying to be as generous as possible to like why someone would choose an IUL?
When it comes to an IUL versus whole life and not comparing any other product, I mean, the number one kicker is just upside, right?
Okay.
Like that's really it, upside and flexibility. Because when you start thinking about anything else, like whole life has the same characteristics built into it. Some would say that you get arbitrage, right? When you're borrowing against it, you get more on the upside than your loan features. And sometimes I think that's also deceiving because there's different loan functions that IUL has relative to the whole life as well. So it's just a little bit more complicated in IUL than a whole life. And you asked about the pros. So yeah, there's not many more except I'm just having more dollars.
So okay, so the pros, and again, we could have a debate on this, but I think it's fair to say that in a perfect world, if designed properly and monitored, I think IUL will and should outperform whole life. And let's maybe give it a 1% difference, maybe a 1% difference. Obviously, I'm trying to be as generous as possible. Like you would choose IUL because of that assumption, because the disadvantages to IUL is there's a lot more levers, and you as a consumer are taking on more risks than you are with whole life. I don't think anyone can debate that. Even people that are pro IUL will say, yeah, you are, but I'm willing to take that risk with a reputable company. But there's more things that could potentially go wrong. And for the purpose of this video, we don't have to go into all of those, but like interest rates, caps can change, like the indexes. Pretty much the company has the right to change a lot of different things. Whereas in whole life, they still have the right to change some things, but they're mainly just messing with the dividend. Like the dividend they can manipulate, but from whole life, from essentially everything's baked in, and so the company is taking on a lot of the risk. And so if you're looking at life insurance, and again, this is like a broken record on the show, if you're looking at it as like an investment, then you understand, like you're already thinking about the risk reward. Like, of course, I'll take a little bit of risk with this strong company to hopefully get some upside. But if you look at it from a non-investment standpoint, and you're just like, no, I want to deploy this in other assets, the question would be, is it worth speculating? Is it worth potentially getting a greater rate of return? But the flip side could be you get a worse design, and in some cases you have a policy that way underperformed. And now you ask the question, why was I speculating with an asset that should have never been an investment in the first place? Dom, anything you want to mention before we look at the illustrations? Because if I had to predict, and I've not seen the illustrations that you put together, but I had to predict, I would imagine whole life is going to look more attractive early on with high early cash value. And if I had to guess, in year 15 or so, the IUL is going to start looking way better. I don't know how much way better, but I think and so then the question is going to be, with the understanding and the philosophy, do you take, because all illustrations are going to be wrong, which one has more likelihood of being wrong? And I think there's certain assumptions that are being made in IUL that I wouldn't feel comfortable. And if I'm going to take a risk, I want to make sure that it's not just a 1 or maybe 2% difference. I want to make sure that it's a massive difference.
Yeah, no, those are all great valid points. And for myself, when I was in the IUL space strictly, once upon a time, I had that philosophy that I should put my money nowhere else. 100% of all of my dollars, everything into an IUL, because it looked so attractive on paper. And I didn't know any better, but I was like, why would anybody put their money in the market? Why would anybody put their money in whole life? Why would even people put their money in real estate? Like, this is dumb. Like, this is so good. And as time went on, there started to become rules within the industry that were created because the IULs were no longer performing the way that they were designed, right? So you had the AG49A, the B, like you had all these regulations that got implemented because the IULs were looking way sexier than they actually performed over a 10-year window. And so that's why at this stage of our career, at this stage of our business, it's very difficult, even when we're just looking at these numbers, because like you said, Caleb, we're going to look at these numbers and yeah, the IUL will outperform the whole life long term. And when you're comparing strictly illustrations, you will lose 100% of the time, in my opinion, when you're trying to fight for an agent with another, so on and so forth. Should I buy a whole life IUL with another consumer? And I've done that before in the past, to be honest with you. Like I've tried to be like, hey, like look at this really sexy whole life that we've designed. It's got high early cash value, and then look at what it does. And then you start talking about the IUL, and you're like, okay, well, this is designed properly as well, but you have no idea if it's going to do this and perform. Like you start having these types of conversations, and when you're always doing that, always people naturally gravitate to the thing with the higher number. And that's why a lot of the times the buy term invest the difference conversation always comes into play, because people are like, well, you'll always have way more dollars in the S&P than you will in your whole life. Yep. It's like, yes, well, that's in an isolated bucket. And so if that was the conversation we're having, then of course that's what you should do. And so it's a lot more bigger picture than just like the one isolated feature that we're looking at.
It's ironic that the IUL uses a lot of same talking points, and again, you go back to why, if you get the OGers that loved life insurance did not talk about rate of return. I realized when I first got in the space, there was such a don't talk about IRR, don't get super focused on that. And I could never understand why, because I'm like, this is actually amazing when you understand other elements. So my mind worked a little different, but they were like, it's a road that you'll never win. Like insurance should not be seen as this, because then there will always be something shinier. So with that, I know we have the cash surrender value in year 1, 5, 10, 20, and 30 of this illustration. So Dom, I don't know if you want to show an IUL illustration that we remade, or if you want to dive right into the whole life. I'll let you decide, but we can kind of reference and compare both of them to show kind of like a apples as best as we can. It's not an apples to apples. The only apples to apples comparison we can do is if the same company, the same illustration, because they're using the same type of assumptions. But we'll do as good as we can to give you like this company's inputs versus this other company's inputs, whole life versus IULs. If you're a high earning professional, entrepreneur, or someone who wants more control of your money, we offer something called a clarity call. It's a one-on-one conversation where we learn more about your situation and walk you through how integrating whole life insurance could help better your financial situation. It's no pressure or fluff, just real clarity on whether this strategy is right for you. Click the link in the description or tag comment below, and we'll walk you through exactly how we can help you.
All right, so what we're gonna do next is I'm going to share a illustration that's comparing a whole life insurance policy and an IUL policy with the same exact insurance carrier. And the reason why that we want to do this is because we want to not neglect the video that we just saw and say, okay, well, we're not going to compare apples to apples from whole life to IUL with what he did. What we want to do is we want to just share something easily digestible, easily be able to be seen on what we designed to be able to talk about the talking points on whole life versus IUL in the same picture for you to view. And so with that being said, let me go ahead and share my screen and we'll go ahead and talk about these illustrations.
And Dom, I think it's important to mention that in the IUL that you designed, it actually outperforms the IUL that this person on TikTok shared with it when it comes to the cash surrender value and the death benefit. I just want to point that out because I think some people could say, of course, you made your own IUL illustration to fit your agenda. Well, actually, this one that we're showing you is in helping us keep things apples to apples, but in all reality, it performs better than what was in this video.
Yeah, 100%. And full transparency, you guys will be able to fact check this because you could easily pause the video, the recording that we essentially just watched, go find the video itself. Within the first 10 years or so, the cash values are slightly less in the one that we're actually showing. When you're looking at sheerly the surrender value, right? The surrender value is super important, like we discussed, right? There's a difference between account value and surrender value. In the illustrations that I'll be showing you, we're just only going to show the surrender value. We're not even going to talk about the account value, as we think that it is irrelevant in this conversation, right? But from years 10 on, which should be the intention when you're looking at an IUL, is looking at a long-term perspective, right? The policy that we're showing here is going to be better cash value wise from an outperformance perspective and also from a death benefit perspective as well. So with that being said, let me go ahead and share my screen. Let's rock and roll and let's have some fun. Okay, let's go ahead and dive in. This makes it super easy for us to compare from an apples to apples perspective of whole life versus IUL. You'll see at the top left side, the name of this says accumulation whole life. And then the top right side, it says accumulation IUL. So what you see here is we have $25,000 a year going into the policy for the first 4 years on both the IUL and the whole life policy. What you'll notice is that we mimicked it to do $6,000 per year, therefore after, just like the video that we just watched. The only nuance that I wanted to make sure, and this actually came from Caleb more so than anything, is that these illustrations were truly an apples to apples comparison. And so when we came to the whole life specifically, there is certain limitations and rules in regards to how much PUA that needs to be funded, with certain guidelines per carrier. And this insurance carrier would only allow us to do $5,179 with the way that it was funded for the first 4 years within this specifically. And so what we did is we did the same exact thing over here. Instead of doing $6,000 all the way down, we just said, hey, we'll just take the same number that the whole life would allow us to do, and we'll actually plug it into the IUL. So that way we can actually get a better comparison from what to expect. And so with that,
Dom, I just want to mention something real fast. If you go down to year 30, and all these are just illustrations, but in this IUL that we are showing, you have more cash value, and the death benefit is pretty much the same as what they showed in the TikTok video. And so just even with putting less money in over a funding period of time, like significantly less, this illustration actually performed better from a cash value perspective than the TikTok. So just go back, but I just wanted to point that out just for any of you wondering from a design standpoint.
Okay, so with that being said, now that we understand contextually what we're looking at, how much money is going into it, the intent of why we wanted to make it apples to apples, let's go ahead and actually look at these side by side. So we're putting in $25,000 the very first year. What you'll see is that the net surrender cash value number is $20,509 in regards to the whole life, and there's $10,100 in regards to the IUL. So you'll see a pretty significant difference in regards to the available liquidity and control usage that you can use. I mean, that's a 100% difference, right? You have double the amount of money that you can utilize for any purpose that you want. Just think of the last opportunity cost, again, of what you could use that $10,000 for if you're using it for leverage for business, real estate, investing, etc. Also, the death benefit is higher in the whole life than the IUL.
Yep.
When we start to get to years 5 on, you can see that we have $106,000 and $93,000 that's going into this as well. $480,000 here into the death benefit. You'll see that the death benefit does stay really consistent for quite some period of time. This is because you have the level death benefit to make this as efficient as humanly possible when it comes to the IUL. So again, we designed this IUL to be maximized for the cash value and not for the death benefit. And then for the death benefit in regards to the whole life, you'll see that it consistently keeps growing over periods of time, which is just the way that the chassis works and excites the whole life policy. So let's just go ahead and go down. You can see that we have a $13,000 difference in cash value, a pretty significant amount of cash value in whole life. All
right, Dom, what I just want to point out is if you look at year 1 in the illustration that the TikToker shared, the net surrender cash value is $15,865,000. So even if we're comparing apples to apples with one company, IUL versus whole life, and even in the whole life, in this example, you do have more cash value even than their projection. In year 5, their net cash value surrender is $100,000 and the death benefit is $500. In the IUL that we're showing, you have $93,000 and then a net death benefit of $480. After year 10 and beyond, the Penn Mutual illustration is going to perform greater from a cash value standpoint, and then obviously the death benefit's going to crank up over time as well. But I wanted to acknowledge that and try to give best of both worlds, like acknowledging the best of both worlds on the whole life versus IUL up front, and then obviously the IUL is going to perform better long term in this illustration. So we can continue. I wanted to mention that just for the people that are watching that video and potentially fact checking what we're trying to do.
Yeah, no, it's a great point. And that's one thing that we want to make sure that we're always doing is try to be fully transparent in regards to our objective of the video, objective of what we're trying to accomplish, and not hide anything from that perspective. And so, yeah, 100%. And then when we're looking at now back to the whole life versus the IUL, the difference in regards to year 10, the cash value, right, is 167 versus 169. And that's essentially right around the time frame where they kind of flip on their head, right? Where you now have more cash value in the IUL than you would in the whole life policy. And something to also consider when we're looking at like the net surrender value versus the account value, which the other policy did show that. This is something that you have to understand in regards to IULs is that every company is going to be so different from the caps, par rates, the way that they credit things, the percentages, also the surrender charges. The surrender charges in the video that we watched, they were all the way to year 15, and these surrender charges go all the way to year 10. And so there is a subtle difference when you're trying to understand like why was an account value so different, et cetera, just from constantly education perspective. When we keep going down here, you can see that there is a number, right? We mentioned that it's kind of a little wonky. IULs and whole life, they have tons of flexibility that's built into it. These are now become the ceilings that you can essentially fund into the policy. And then there's a minimum amount that you can fund into it. The minimum on this one is essentially zero. So that is the flexibility that comes with it. The minimum premium payment that you would have to fund if you wanted to continue to keep funding it afterwards would be right around like $2,000-ish in this example. But in theory, you could make zero on both sides to where you no longer have to fund either of them if you wanted to, and we wanted to compare it from that perspective too. So just know that whole life and IUL both have lots of flexibilities. And again, when we're looking at an IUL, my personal experience is once you do fund it to zero, a lot of times trying to turn it back on, you never do. When you do fund it zero into the whole life and you flip that switch on, you actually can't flip that switch back on in a lot of instances the way that it works. It naturally has a minimum premium that you still are required to pay, which I do think creates a safety net in regards to a whole life, which prevents more surrenders from happening in a whole life than in IUL. Okay, so now when we're looking at this, let's look a little bit more from just the long-term perspective, right? We saw the 10 years. Let's look at the 20-year. You can see that in the whole life, you have a total of 345 versus the 399. So you can start to see that at year 20, it's a pretty significant amount of difference. It's a $50,000 difference in regards to total control, cash value, et cetera. But the death benefit is still greater in the whole life. And so some people may look at this and say, you know what? I actually don't mind having $50,000 less of cash value, knowing that I actually still get a $400,000 difference in death benefit for my family for protection, right? We got to look at the entire picture. We don't just look at one thing. When we're looking at planning, insurance, all of this is super important and how it fits in the bigger picture. Like Caleb mentioned, when you start to get long-term, right, we only have this funded for 25 years on both sides. At year 30, again, to overemphasize, there is a $610,000 of cash value in the whole life versus $823. So you can see that there is a massive difference now in that perspective. And then the other thing too is the whole life now has been surpassed in the death benefit starting in year 29. You now see that there's more death benefit in the whole IUL than there is in the whole life policy. And so when it comes again back to what it is that we want, what we're trying to accomplish, sometimes looking at it in regards to short-term versus long-term goals is also very important. And then the risks that come with each policy.
Yeah, no, I think it's well said. And it's a couple of things that I just want to point out is obviously if someone looks at this and if it's like comparing apples to apples from a standpoint of like the same input assumptions, like the same, if this is a whole life versus a whole life kind of deal with the same company, which is kind of crazy to say out loud, but if that was the case, I would choose the one on the right, even taking a hit early on with cash value. I'd be like, yeah, over 30 years, I like the trajectory of where the IUL is going. The issue is we're not dealing with an apples to apples comparison, and it obviously we go back to and actually, believe it or not, Penn Mutual is more conservative on the crediting rate than what this other person, but their internal fees are a lot lower, so that's why it actually outperforms. But that just goes to show like how sensitive different things can look like. You would think if one company had a higher crediting rate, they would blow out a lower crediting rate IUL. Why are we funding with less money over less period of time and the cash value being greater? That just tells you how sensitive things are when it comes to internal charges and all. And if it's this sensitive, imagine over the next 5, 10, 15, 20, 30 years, something changing. Now you go from being $200,000 ahead to it maybe even being behind, or there being some big difference. And so it goes back to the question: if you're using this as a safe foundational asset, when would you you just have to share the pros and cons. And we've had people that have come to us that are like, hey, I want to do both, and that's great. And they look at the pros and cons and they feel really comfortable. Like, especially with a mutual company like Penn Mutual, they're like, hey, I'm banking on the fact that they're going to stay true to who they are and they're not going to do any shenanigans, and I'm willing to take that on. And then it just goes back to the philosophy around life insurance and why R. Nelson Nash and other people are like, hey, if you're going to use for infinite banking purposes, stay true to the fundamentals. But I also want to be straight up and say, if someone really wants an IUL, we will set that up for you. And as long as there's clear disclosures, as long as things are monitored, I think it's important to understand the pros and cons. And the last thing I'll say is, if an IUL underperforms a whole life, that should be like a long term based on an illustration. That should be like the greatest red flag of all time, because even in a poor, and I'll use Kyle Busch example, that policy that Kyle Busch allegedly is saying he lost $8 million on, I guarantee you that illustration that he looked at was far greater than any whole life. And I know that's an extreme example, but you're not going to see those kind of crazy extremes in whole life, versus if it's possible to do it on the IUL side, it just makes you wonder. And that's really what you have to go to the table with is it worth a little bit extra cash value, in this case over $200,000 of cash value over 30 years. But how confident and how certain are you when it comes to that? So I know I just that was kind of like my conclusion, but what is your thoughts on this? Because if someone could easily look at it and say it's super black and white, and unfortunately it's not black and white because we're dealing with illustrations and different input assumptions.
I think the Kyle Busch situation that you mentioned was a prime example of what we're trying to get our point across in regards to this video, is that you have one illustration that will show that it's a whole lot better from a sheer dollar perspective, but that doesn't necessarily mean it's the best route you should take, right? He looked at this illustration and saw these massive numbers and said, I'm going to retire rich, I'm going to retire good, I'm going to ride off into the sunset. But there were other factors that played into this, right? In regards to how the insurance company with certain multipliers, the transparency in regards to how some of that worked, him funding less than the full amount that he probably should have in regards to what was shared at the very beginning. The illustration showing, $3 million per year, but in, years 3 or 4, if you only fund $750,000, that highly affects the performance of the policy with the fees that are in, the cost of insurance and other things that are there. And so you just have a whole lot less risk and levers that are moving in one versus the other. And if you understand that and know that, that's okay. That's what we're trying to get the point across, is not saying that one is inherently bad and one is inherently good. You just have to fully know your options and what you're getting into before you truly step into the deep zone. And if so, then great. Let's go ahead and facilitate and let's go ahead and move forth.
Yes, I love it. And I think that's where we can end it. I look forward to hearing your thoughts. I have good friends on both sides of the aisle, and I have good friends that are a big fan of max funding IUL contracts. They'll even use it for use the cash value for other things, and they would argue the reason they do that is when structured, funded properly over a long period of time, you're going to get the upside of the insurance and all the other benefits that they mentioned. And in some ways that you can design IULs, you can get a lot of early cash value as well. So those are some of the those are some of the talking points. And then I have other friends that will go to their grave. Literally, they'll go to their grave saying that IUL was the worst thing in the world, especially in the insurance space. And it's very much leaning into the buy term and invest the difference, that talking point, and it will never hold a candle to the permanent nature of whole life and the risk that you're now taking on. So it'll be interesting to hear the comments, and I would love to hear your feedback. And we just are so grateful for you guys supporting this show. It's fun to be able to flesh out conversations like this and hopefully help increase the financial IQ of just our audience.
Yeah. And the last thing that I will say is you guys that are watching this probably feel like we are sheerly IUL camp, or excuse me, whole life camp. And like we're bashing IUL sometimes, like that may be the sentiment. And I personally try to stay in the agnostic boat, right? And it may not come across that way. The reason why it may feel that way is I was actually talking to our head of media, and he was saying like, hey, like if we're going to be agnostic, like we kind of really need to posture that way in a lot of ways. And sometimes it's inherently hard to show the agnosticism because for myself personally, with my headspace, my mindset, who I am, where I'm trying to go, my investor DNA, all of those things, I personally, for Dom, lean towards I would rather have a whole life versus an IUL. And so it's the same thing when I was telling him, I was like, hey, like sports are great across the board, right? You know, in the right context, sports are amazing. I like football more than I like pickleball, right? So therefore, I'm naturally probably going to speak more highly about football than I would pickleball. But Caleb loves pickleball, so he'll speak highly about pickleball, but he can't say like football's bad for your health when, I'm not going to say like pickleball is bad for your health. You just naturally speak more biasly towards one when it is different towards you than somebody else, right? Even though I do believe that somebody else, this product will be better for in certain scenarios. And I agree with them. All right, cool. You showed me that why IUL is better for you, and I'm here for it. So.
Yeah, Dom, you give me so much content. You're giving like a fellow debater so much content to work with. Here's what I'll say. I love football too. I think a better example would be football and rugby. Okay, neither one is bad, but there's the reason why in America we watch more football, blah, blah, blah. Because I think there's a lot of health benefits to pickleball that we could debate all day long, and I think I would win, but what's new, So but I'm a fan of football, and I watch more football than pickleball for what it's worth. So with that, let us know who's right in the comments. We love you.
Before we dive in, let me set the stage in regards to what we'll be looking at next. I am going to share a ledger, essentially an illustrations of a company, Penn Mutual.
Hey, let's redo that. Sorry. I wasn't feeling it. I wasn't feeling the flow. Okay.
It's really hard to do it when you don't know where this is going to tie into, where spot into the video.
This to get you in a good mental mood. Here, this is what I was hearing there.
Where are we? Where is this going to be fitting? Okay.
Here, this is what I was hearing.
Okay, amazing.
Your mental focus is. Oh, it's focused. I haven't, look, I have trouble even saying to myself my own head the number of years. I no more think of myself as being as old as I am than fly.
What's funny to me is that Caleb has this. Caleb has this on the.
Oh, it's on my save.
On the save.
It's hilarious, dude. I just love how joyful Joe Biden is in the midst.
Joel, this is the thing that I actually really like personally. I mean, we don't have to do it, but if you found a way to put that in there with me messing up and the kids like, hey, we got to do this over again, and then we actually do it over again, that would be great. I think that's like the stuff that would build real rapport.
Oh, geez.